Hey everybody, welcome to the 1947 Rise podcast, a podcast that helps India-born, US-trained Indians get integrated into the Indian technology ecosystem and inspires them to move back to India to build massive tech companies and or help enable the tech ecosystem. We do this by interviewing India-born, US-trained Indians who have moved back to India and built massive tech companies themselves and or helped enable the tech ecosystem. Awesome. I'm excited to have Rahul Khanna today on the 1947 Rise podcast. Rahul Khanna is the co-founder of Trifecta Capital. Trifecta Capital is where great companies meet great odds. Trifecta's maiden fund was India's first venture debt fund. Today, Trifecta Capital manages one of the largest venture debt funds in India, and it also runs a pre-IPO growth stage venture capital fund. Rahul backed companies like Urban Company, Rivigo, BharatPe, and Infra.market, to name a few. Prior to founding Trifecta Capital, Rahul was the managing partner at Canaan India Partners and director at Clearstone Venture Advisors. Rahul, welcome to the show.
Thanks, Shiva. Great to be on.
All right, we'll dive right into it. Would love to hear about your journey so far, your background, growing up in India, then moving to the US, and why did you decide to move back to India? And how was the move like?
Sure. Going to have to jog the memory a little bit because I turned 50 this year. So I sort of feel like the grandfather of venture capital in this part of the world. But, I did grow up in Bombay, went to school here, went to undergrad here. And this was in the 90s when I got done with college. At that time, the telecom industry was just getting privatized. And I found an opportunity to join a little startup called MaxTouch, which 20 years later is now called Vodafone. But back in the day, it was really exciting because telecom was getting mobile and we were out there really pioneering a completely new form of communication. So I worked for Hutchison for a few years, and as luck would have it, I allowed myself to travel with Hutchison to various parts of the world, worked on launching their businesses in Israel, Sri Lanka, etc. And then, like many of my peers, decided to go for an MBA. Given the scramble of having a day job, I applied to 3 schools, got into one, was lucky enough to get to Kellogg, Northwestern. Yeah. Nothing prepared me for a winter in Chicago. And, I made a promise to myself that the day I get done with college, I will move very quickly. Got done with business school in 2000. It was the glory days of the dot-com era. Things could only go one way. It was up and to the right. Most of my class coming out of business school went into banking, consulting, consumer. A few brave souls like me decided to go to Silicon Valley. I passed up on a couple of job offers at business school that would have paid off my entire student loan. Mm-hmm. But I think the idea of being in the Valley just drew me in. And so took the first flight out the next day after graduating, moved to San Francisco with no job, no visa, and started banging on doors in the Valley, alum of the business school I went to, plus a few other people that I knew. And as luck would have it, given my telecom background, my degree, I was hired into a very exciting startup that was doing location-based services. 6 months later, the Valley started to crumble. 12 months into it, we were in a very dark hole. That company got acquired by another French company. So I moved to another startup. This was a quintessential Silicon Valley garage-style company, 6 engineers in a room, most of them from Bangalore, incidentally, and a CEO who looked at me and said, we need to go raise a round of funding. Can you write a business plan? And I said, absolutely. Yeah. And so I got hired into a firm called Sonim Technologies, and we were doing voice over IP on 2.5G networks. So things like walkie-talkie service on a regular mobile phone, which was quite a novel thing back then. So really got in on the ground floor, we went out and raised a fairly large round of funding back in 2002, because at that time things were really slow. And in a way, it was a really interesting experience to see both sides of the valley, both the up and the down. You sort of start to see the benefit of surviving cycles and really building that resilience in the organization, and just kicking yourself out of bed every morning saying, we're going to get there, we're going to get there. Because fundraising, at that time was brutal, right? I think we must have knocked on every door on Sand Hill Road, but we did get lucky. We got funded by Accel, 3i, a couple of other folks, and went on to build, first their sales and marketing team in the US, and then increasingly started to look at international opportunities. By late 2004, I'd been traveling a lot to Asia, actually visiting India, visiting China, Thailand, Vietnam, etc. And we're starting to see the green shoots of the internet taking shape. We had about 1 million people on broadband, 2.5G was sort of more widespread, starting to see patterns of adoption of the internet in India that was similar to what had happened in the US, 10, 15 years ago. And told my wife that, look, I think the future is back home. And she very kindly agreed to get on a plane with me. Again, the idea was we'll go and figure something out. So you'll see this pattern repeats itself, which is sort of take a leap of faith. And I've often told, people who want to be founders that, look, until you jump off the hill, you won't know if you have a parachute on, right? And so you can't pretend to take that leap. You have to take the leap.
You have to do it.
So I did, take the leap, and, maybe it was foolish, maybe it was brave, but came back to India in 2005 with the idea of doing something entrepreneurial. And very quickly, started knocking on doors to raise capital. But, most of that ended up with conversations on families saying, why don't you build this business for us? We're not sure if we want to allow you to build a business. So I started to reflect on the gap in the market. And what I realized was that there was a lot of talent in India, but there wasn't any venture capital in India. This was pre-Sequoia, pre-Accel, Lightspeed, Elevation. Most of those names were not present in India. So reached out to friends in the Valley, known a firm called Clearstone. They just raised their second fund. And one of the partners there, Sumant, and I go back a long way. And I said, look, looks like things are happening in India. There's probably many guys like me running around, trying to raise money. Why don't we allocate some capital to India? So I think to their credit, I think they took a punt on me and they said, okay, let's carve out 25 million. And, why don't you start identifying opportunities for us in India, and let's start doing deals in India. So I sort of stumbled into venture capital, just given my operating background. And I think most of my peers, whether it was the guys at Matrix or Nexus, or most of us who started in that 05, 06 vintage, were largely people who came from some sort of operating background. Nobody had any track record in investing. And the truth is that there is no school of venture capital, right? It is an apprenticeship business. I was lucky enough for 10 years between Clearstone and Canaan Partners to be apprenticed by some people who had been doing venture capital for a long time. And I think that was my, learning curve. And over that 10-year period, you start to build some principles around investing, right? Things that you like, things that you don't like. You start to build your own patterns. And in a way, venture capital is a pattern recognition business, because, one hasn't seen the future, but you start to see patterns on companies you worked with 2 years ago, 5 years ago, 10 years ago, that went on to build something significant. And so the data set grows with time. And therefore, I've always told people that venture is an end of life career, right? Because once you cross over to this side, there's no going back, right? And you pretty much become incompetent at running a regular business. But you do get very good at hopefully seeing patterns and connecting the dots, and as we say on our website, improving the odds of success for our portfolio companies. So the transition back to India actually, was interesting because, one had to learn a few new things and you were out of your comfort zone. But candidly, I think there is sort of if you've been out 7 to 10 years,
Yeah.
I actually think it becomes very hard to move back because, the hygiene that you get used to, things working a certain way,
Yeah.
that can be a tough adjustment phase. And I know because a few of my peers, from business school, et cetera, also moved back in that '05 to '08 vintage. And about half of them went back to the US, right? They just look, there's too much friction, things don't work, the electricity goes off, things like that, were still a problem and continue to be a challenge in some parts. But I think that's the opportunity, right? So what got me excited was that innovation in the US tends to be incremental, right? Once in a while, you'll have a breakthrough, massive business, but you're really trying to extract that 1%, 2% more. I think innovation in India is fundamental, right? You're doing a lot of 0 to 1 stuff. Things didn't exist, and you're building a brand new ecosystem, right? So if I just draw a parallel with, Trifecta and venture debt, we got a chance to build a new asset class, right?
Yeah.
Now, you can't do that in mature markets, right? And similarly, for many of our portfolio companies, they're actually building whole new segments of the market, whole new sectors of the market. So that's the really exciting part about coming back to India. And I still think we have a lot of challenges and problems to fix. And therefore, the next 10, 15, 20 years should continue to be very exciting.
Well, you do not look 50 at all. You look around 40, early 40 or maybe late 30s, but you are the godfather for venture debt in India. And Rahul, what was the founding story of Trifecta Capital? And it's a completely new asset class that you're creating in a in a market that's not as exciting as what is today, right? I think you built that early 2014s or something. What was your pitch to your LPs, and how was the process?
Sure. I think like any other business, starting a new fund or a new firm requires one to think about product market fit.
Yeah.
And what we realized back in the kind of 2014, 2015 timeframe was that companies in India were growing. There was a lot of capital available by way of equity. But many of the conversations I would have with founders were that, look, this equity is great, but I'm funding inventory and working capital and deposits and CapEx with equity, which is really expensive. Why can't you provide me debt? And the answer from me as a VC fund was, look, we don't do debt, right? That's not our mandate. And it's very complicated to do it as a foreign investor anyway. So why don't you go talk to a bank? And the answer was, look, banks will not give us attention. We are loss-making companies. We don't have collateral. We don't have security. So this narrative, got louder and louder. And as I was thinking about, what it'll take to build a new platform, one also needs to think about differentiation. And it's very hard to build a better Sequoia or a better Accel, but it's a lot easier to build something that somebody hasn't built before, right? And so the idea was founders and companies that were growing needed a form of growth financing that was optimally suited for the risk that that company was at. Equity may not be the only instrument that they should use to build their business. And if we can take a page out of how the Valley evolved, where as the equity supply matured, products like venture debt sort of also emerged, that would be an interesting way to plant a seed for Trifecta Capital, but also provide a solution to the market that is missing. The other side of the coin is investors, right? Because finally, we exist to serve them and deliver great and consistent returns to them. And what investors were saying, particularly Indian institutions, was we like this venture stuff, but we don't understand it. And we don't have the appetite to lose money. So when they think about venture capital investing, they thought it was very risky and it had very long duration and the outcomes are very uncertain. So we said, okay, that's their challenge. How do we then address their challenge of duration, risk, and return? So rather than a 10-year fund, we thought about doing a shorter fund life. So we did a 7-year fund. Rather than doing very early stage, we said that we will typically invest after Series B. So we explained to them that the risk profile is significantly different. And then we also said that, because it's an income generating product, you'll make a yield every year in the low teens. So you sort of secure a baseline return. And then since we have equity options in all our portfolio companies, you can get some upside as well, which takes the return profile into the high teens.
Yeah.
And that was a narrative that got them very excited because they were quite conservative, but they liked the idea that we were senior lenders to these companies, that the risk profile was different. And we ended up, bringing in a bank and a very large endowment as our anchor investors, which then sent the signal that this asset class is kosher, because if it's good enough for a bank and good enough for a large endowment, then it must be good for a large insurance company or a large treasury. So we actually went big game hunting, right? We've said, look, we've got to get a Kotak, we've got to get an HDFC, we've got to get an LIC, and that will bring credibility to the asset class.
Yeah.
And that's what happened. We got lucky. I think it was right time, right place. And then the product sort of made sense for both sides of the table. And we ended up raising, around 500 crores for a fund back in 2015, which, was a sizable amount for an asset class that didn't exist and for a manager that candidly didn't have a lot of track record in venture debt. I'd never done a day of credit before Trifecta Capital, but my co-founder, Nilesh, had an exceptional background as well. He'd actually been a debt fund manager. He'd also helped co-found a company and sold that to Accenture. So both of us had, operating backgrounds, but I'd spent a lot of time after that in an equity-oriented investment role, and he'd spent time as a credit guy and an operating CFO. So we took both of our skill sets, and I think that also helped bring the platform to life.
Yeah, no, and you have that thing where you've been pioneering things, and you also launching new stuff. So recently you've launched a fund that's pre-IPO or growth stage, you call it. So it's been 7-8 years, Rahul. What's the vision that you hold for yourself, for your team at Trifecta in the let's say next 5 years, 10 years?
Sure. So yeah, I think the idea always was to be a partner in growth.
Yeah,
The best companies being built in this part of the world. And you have to then identify the natural gaps in the market and try and fill those with people and product. So back when we started with Venture Debt Fund 1, the gap was really around this kind of growth financing in the form of debt. A few years later, as we were spending time with these companies, we realized that actually the founders very focused on the front of the house. The VCs were also very focused typically on people, technology, customers, but there was really nobody who was the custodian of the back of the house, what I call the stock and flows of money.
Yeah.
And so he said, why don't we build capabilities to support these founders with just managing the capital that they raise? Because if you don't do that efficiently, you end up maybe taking risk with that money, you're not disciplined with that money, you're actually compromising the runway for your business.
Yeah.
And a lot of founders said, look, I don't have experience, I don't have expertise, right? I wasn't trained in treasury management.
Yeah.
And I've got to focus on my customers and my business. So we actually launched a advisory practice. We built a cloud-based treasury solution. And today, I think we have several thousand crores of treasury under management. And we've taken a lot of the pain away from the founder to worrying about managing their balance sheet. And so now, they have the ability to look at their overall reserves in real time. They can do their forecasting. They can move money around as they need. And because it's better managed, they don't have to break an FD. So they actually get better returns on the capital that they have under management. So we launched a second vertical, and this has now become the CFO's best friend in these companies. And then as the market continued to grow, we did see that while there was a lot of early stage capital, Series A, B, even C, when you got into Series D, E, maybe crossover to IPO, largely that was dominated by offshore players.
Yeah.
It was global funds, it was crossover funds, Chinese money, Russian money. And we started to see that there was really a gap in growth VC, right? It's an asset class that really hasn't been built out as yet in a big manner in India. And we thought that if we could hold the hand of companies into the next leg of the journey, typically Series D and beyond, and maybe even leading into the IPO, plus bringing a lot of our relationships on the ground, access to capital markets, access to large Indian institutions, access to anchor investors, it would be complementary to what the TPGs and the Warburgs do at a much later stage. So the idea was, can we continue to work with the best companies or the ones that have reached a point of maturity where we can allocate growth venture capital as well? So, that was really the genesis of sort of the Trifecta Leaders Fund. And we said over the last 7 years, we've had the opportunity to work with 100 great companies. Maybe 15 of them will have gotten to a point where they can be part of the Leaders Fund.
Yeah.
And so we've ended up, raising, we're targeting a 250 million fund. We're at about 210 million now. We've already deployed about 125 million of that into 10 companies, of which 7 were legacy Trifecta venture debt relationships. And that gave us the ability to actually understand these companies better, because as a growth investor, you have to worry about adverse selection, right? Because the best assets, it's really hard to get into, right? So then you're left with everything else. And so the question was, can we get into the best companies? Yeah. And given our relationships with the founders, given our relationships with the current investors, the fact that we'd been part of their journey, we actually were able to get into some incredible companies. And we hope that over the next 2-3 years, many of them will end up becoming public. Yeah. So if you now think about the flywheel, right? We have a credit offering, an equity offering, and an advisory offering. And depending on what stage a company is at, we can begin a relationship in a particular manner, and then hopefully work with them, through an extended period of time. So we have sort of 3 guiding principles, at the firm. One is that we're in the relationship business, not the transaction business. Yeah. 2, that we provide solutions and not product, because, generally speaking, we try and work with a company to build a solution. And so there's no cookie cutter type of opportunity. And 3, we're very founder centric, which is for us, in a way, building that relationship with the founder early and holding their hand through different kinds of experiences allows us to stay relevant to them. And in a way, what I kind of test ourselves with is, will we get the first call, right? When a founder needs something, are we on their top 3 call list, right? And therefore, will you continue to be relevant all the way to the finish line or to whatever the next milestone might be? So I think those are the things that we look for, even when we look to bring people into the firm, which is, do people have an owner's mindset, right? We are not necessarily in the capital allocation business, right? We, of course, look to invest, we look to drive great returns, but a lot of our team have actually had operating backgrounds. Several of them have been founders before. So what we are looking for is people who come to the firm with a view to being here long-term, come to the view to being able to solve problems, and then hopefully, invest like it's their money, right? And we want that discipline, that this is not somebody else's money, this is our money, and that we are responsible for it. And hopefully, if we do the right thing, we will continue to grow the firm.
Rahul, I must say, you have an amazing strength or superpower of, thinking differently and spotting the opportunities, and more importantly, going in and executing them, right? And it's a very, very, interesting, a solution, I would say, the Trifecta Capital that you've built in the ecosystem. And plus also, Rahul, I'm sure there must be a lot of, learnings or lessons you've taken, over the years. What's something that you know now you wish you had known it earlier?
Yeah. No, first of all, you're very kind. I think it's been a labor of love. And I think in a way, if I'd known how hard it was going to be, maybe I would have thought twice about it. But I think, what I know now is that, the founder journey does involve making significant trade-offs. right? Whether it's trade-offs of health, of family, of lifestyle, um, and I think you can't have everything, right? And so I've always used this little triangle, and when people tell me, what are you solving for? You can either have knowledge, or you can have wealth, or you can have relationships.
Mhm.
You can typically get 2 out of 3 at
Yeah.
any time. So you can chase knowledge and relationships or knowledge and wealth, but you typically can't get all 3, right? So for me, I think it's been the pursuit of relationships and knowledge. And I think if you kind of continue to prioritize building great relationships and learning, over time, the wealth will just naturally follow, right? So I think it's really about making choices around who you surround yourself with.
Mhm.
I often, and this is, I tell my kids, you're kind of the average of your 5 closest friends, right?
Yeah.
So pick your company wisely. And I think as you get older, this becomes even clearer, right? Because in a way, that is the peer group that either motivates you or challenges you to keep doing more, right? And so I do think that, as you go through this journey of building something, uh, the challenges from 0 to 1 were different. I think the challenges from 1 to N are different, right? And the 1 to N journey does require one to spend a lot more time thinking about just the organization differently. 7 years ago, it was 2 guys and a pony, and there's a lot of hustle, and you did all of that. I think the challenge really is, as you grow the organization, how do you then create that same level of commitment to the goals of the firm, and how do you instill that culture across an organization, particularly one where it's not a 9 to 5 job, right? It is not a command and control. Most of the people that work here are very talented, they're highly pedigreed, they can find a job anywhere. So how do you build a place that attracts the best talent in the world,
Yeah.
but more importantly, keeps the best talent in the world,
Yes.
right? So that, is the thing that keeps me up, right? Which is, can we continue to draw in the best people? Are our incentive systems aligned to make them perform to their best? And if
Mhm.
they are performing to their best, then can we reward them best in class, which then gives them no reason to leave, right? So I think it's that virtuous sort of cycle where it begins with, can you draw in the best talent, right? And best means different things to different people, right? It doesn't necessarily mean all the logos. It means people that are aligned to, in a way, the mission of the firm, right?
Yes.
So I don't know if I answered your question, but sort of, I think I did.
No, absolutely. It's mostly about the relationships and what got you here won't get you there, and getting good people in is it's hard, but relatively easier than retaining them.
Yeah.
Rahul, you've had a fantastic career so far, and I'm sure still it's a long way to go. You have big plans ahead, but the reality is probably it has been a roller coaster ride. And how do you make tough decisions?
Yeah. Look, I think the hardest decisions generally, are about people, right? You can get an investment right or wrong. It doesn't necessarily kill you. It shouldn't, right? I think there are many things we don't control. I think, first of all, as investors, we should realize that 99% of this is luck, right? But I think luck favors a prepared mind. And if
Yes.
you see a great founder and you make the connection, that's getting lucky, right? So I do think that, the tough decisions, around people, particularly keeping people, or asking them to go, is been the hard part, right? Because I think as you grow, you start by hiring, a Swiss Army knife, right? You want people who can do everything. But then as you grow the organization, you start to see the benefit of some real depth of experience, functional knowledge, relationships that are, in a way, more aligned to the needs of the organization. So I think that's always a challenge for companies, right? that transition from, everybody do everything to then trying to organize yourself where people do what they do really well. And therefore you're building capabilities to go deeper and deeper, right? So thankfully, we've not necessarily had a lot of those kinds of challenges, but I think clearly as we continue to grow the firm, there is a way of organizing the firm so that from a company standpoint or a founder standpoint, they see Trifecta as one. But from a capability standpoint, the skill set you need to be a venture debt provider versus a growth equity provider or a public equity investor are very different. So how do you build those capabilities to be best in class on this side of the table, right? So that is, I think the sort of challenge, that we have to address. And I think you try and do it by maybe saying, okay, where does the DNA fit and where does the DNA not, right? So I think wherever we've had to make tough calls is where we just felt culturally, it wasn't necessarily performance, it was just culturally, this person may not be a good fit, for where we're taking the firm, right? I think, other than that, the tough decisions haven't really been, so let me kind of think about this from a fundraising standpoint.
Yep.
What was really tough, was trying to build an independent platform.
Yeah.
Because, we did have offers early on, we had LPs who said, look, I'll come in as a large anchor.
Yeah.
We will jointly own this business. It was very tempting because, that first check is always exciting. And when you have a large, corporate house say, look, we can't build this in-house, but we're happy to sponsor you and we'll take X ownership in the business. That was a tough call, right? Because in a way it was a guaranteed path to fundraising, but it also, I think, limited our ability to build a new institution. So I think the guiding light has been, does this help us build an institution or not? Right? And if it doesn't solve the institution building journey, in a way also building a new brand, then probably it's not the right thing to do. So for example, taking a lot of money from HNIs is an easy way to raise a fund.
Yeah.
But it doesn't necessarily equip you to scale as an institution. Using distribution to raise money is a great way to raise money. But when you give up that much fee to distribution, you can't pay your own people really well. So I'd say the tough choices were around staying independent and not using maybe the easier path to raise capital, but taking a much more difficult path, which in hindsight has allowed us to really continue to scale. And many of our investors that were with us in venture debt, when we said we're doing our growth equity fund, a lot of them crossed over because we'd built the trust and they'd seen us through cycles. That would not have been possible if it was a very long tail or if we had gone through intermediaries. So I think that was one of the key questions, which is, if this is not helping in institution building, and it doesn't help, continue to strengthen the firm, then it's probably not the right thing to do.
Yeah, you've followed the path of hard choice now, easy life later, easy choice now, hard life later. And Rahul, you've seen it, most of it, starting from your formative years in Silicon Valley and then being very, very early in India, in the Indian startup ecosystem. A change that you would like to see in the Indian startup ecosystem?
I think you made a point, right? It's not a change. I think we want to see more founders that are long-term greedy, right? We are, in a way, from a maturity standpoint, the late 90s in the US, right? People have had their first exit. We've had our first few IPOs. But, in a way, the benefit of being in the Valley is most of the people you're looking to fund are on their second or third company. and therefore I have a lot of experience of doing it one more time and one more time. And look, that's not always what you need, but I would say that, making those mistakes previously, hopefully you don't repeat them again. And the understanding that, the cadence of building a business, also pacing oneself, right? There's no rush to glory. If somebody's going to build a business that's going to last a generation, then, they should pace themselves as well. I think we've also gotten used to capital-led growth. So that's something that we need to unlearn a little bit, because it just was very easy to throw money at the problem. So I think we need to unlearn some of that. I'm excited about operators becoming VCs. I think for a while, this side of the table, wasn't necessarily as diverse. We didn't have enough women as VCs. We don't have enough founders as VCs. When you look at the US tipping point moment, whether it was First Round or Andreessen, that they came and changed the game to some extent, right? And I think India hasn't had that moment as yet, where, a few amazing founders decide that the next thing they're going to do is just help build other companies, right? So I think a few things, unlearn some of the lessons of the last few years, build things that are generation long, and really see more founder-led, funds. I think there was a lot of debate, right? Which is better, founder-led or non-founder. In fact, there isn't actually any statistical evidence to say that it is better. But I think in my own experience, just the intuitive sense of what it takes to build something, having done it before, just allows the conversation to be more real, right? And I think when we engage with companies, it just makes it more authentic.
Love it. Rahul, we'll switch gears here.
Yeah.
What's something you're super obsessed about, both professionally and personally lately?
Oh, I'm super obsessed about staying, keeping the firm relevant, right? I think with capital becoming a commodity, how do you stay relevant when so much money is sloshing around? And how do you make sure that the best founders see you as somebody that they care for and they want around the table, right? So I think striving for relevance, salience, when capital is a commodity, is hard because there's so much money available, and creating differentiation in an asset class that is, say, 1 degree removed, right? Venture debt is 1 degree removed from venture capital. And equally in growth equity also, we're not the largest check in the room, right? So if you're not the largest check in the room and you don't necessarily have, direct influence on the board, how do you yet, create that form of differentiation where the founder says, look, I really want Trifecta to be part of this journey, right? So that's something that I obsess about. I think personally, I think that there's a whole world that I'm not yet familiar with, particularly, around Web3. I am personally late to the party. And I feel like there's a lot of catching up to do, because I think it's a whole new internet in a way, right? There's new forms of distribution, there's new forms of monetization, there's new forms of distributed forms of ownership and business models that I haven't fully been able to get my head around. And I think with all of the regulatory challenges in India, some of those business models may not necessarily prevail here, but it doesn't mean that they aren't relevant and they shouldn't be built. So I am, trying to play catch up on the changing nature of tech, right? And just the changing tech infrastructure around us, because one doesn't want to be necessarily left behind in an industry that is changing so quickly. I think the other thread that runs through, life is just staying healthy. And I think, as you get older, that is something you realize, I think the day you realize that you are not immortal, and, till you're 30, maybe 35, you actually do have this sense of immortality, right? But I think the day you realize that, there is going to be a finish line, and you have no real control over other than the quality of life that you lead till that point, right? Is a game changer, because then every day, becomes precious, right? And I kind of joke about it, and my kids hate me for this because I tell them every morning, today is the first day of the rest of your life. So it's a new beginning. And so make it count, right? And the other thing I tell them is, look, live every day like it's the last day of your life. Right? So, do what you love, say what you mean, don't hold back, right? So both of those are important, right? It's every day is a new beginning, and every day could be your last, right? So don't waste it.
So you look fit at age 39, and what's your fitness schedule like, or eating pattern?
Yeah. About 10, 12 years ago, I got into doing a little bit of kickboxing and non-combat MMA. And I think it was one of the most exciting things I started doing, and I've stayed pretty regular. So typically twice a week, I'll do a lot of kicking, punching. It's a great way to work out, a lot of the stresses that we have in life. And then a couple of years ago, I added yoga, because it was one of those things where you sort of want to do it, but until you start it, you really don't know how great it is. So I'm lucky enough now to have, a great yoga instructor and a great, kickboxing instructor. So typically 3 or 4 times a week, we'll get that in. And then, I think just eating in moderation and drinking in moderation, I think are good, lessons to hold in life.
Another thing I'm enjoying. So I had Nitin Kamath on the podcast the other day, and he is also so obsessed about his own health, and he had similar takes as you had. It's mostly again about being healthy. And Rahul, if money and attention are not needed anymore, and let's say for the time being, Trifecta Capital is not there, what would you work on? What would you do?
Sure. Look, there's a part of me that really enjoys building. And I think, in a way, everything I've done, has been to feed that desire to build something, right? And so my alter ego would be out there, probably studying architecture, looking to build something again. But I have a lot of love for form, structure, aesthetic. And so probably if I wasn't pursuing this path, I'd either be studying about architecture and design or building something related to design. I do think that everything we do comes from some sort of deeper rooted interests and passion, and I think it's so important to try and find that right in oneself. I've been lucky enough to manifest it in the way of building a business like this, but I think different people will find their own calling and hopefully manifest it in whatever gets them excited every day.
Love it. Rahul, I had so much time, so much fun having you on the podcast. It was a great conversation. Thank you so much for making the time.
No, Shiva, I really appreciate what you've been doing, getting a bunch of folks on to share their journey. And I wish you all the best and hope to hear many more of these.
Thank you.
All right. Take care.